Did you know that Chipotle, the famous fast casual restaurant chain, is about to make NYSE history with a rare 50-for-1 stock split? That's right. Known for its commitment to providing mouth-watering and nutritious meals made from whole, unprocessed ingredients, Chipotle has always been a game-changer. And this time it's not just about food, but about their stocks. Chipotle, trading under the symbol CMG, announced a proposed 50-for-1 stock split that has been approved by the board. If you're asking why, well, the split aims to increase accessibility to the company's stock, which is currently sitting at over $2,900 a share. Quite a hefty sum, isn't it? This proposed split is not your run-of-the-mill stock split, oh no. It's one of the largest in the history of the New York Stock Exchange. While smaller ratios like 2-for-1 or 3-for-1 are more common, Chipotle is going big with a 50-for-1 split. If you're a shareholder, this means that for each share you hold, you'll receive 49 additional shares. Quite a deal, isn't it? The company's strong financial performance and record revenues have led to the decision for this split. And while the board has given the green light, shareholder approval is still pending and is expected in June. If approved, trading is expected to begin post-split in late June. Now, you might be wondering, what exactly is a stock split and how does it affect shareholders? Well, stick around as we dive into that next. Okay, so what is a stock split? In simple terms, it's a corporate action that increases the number of outstanding shares while adjusting the price per share. Think of it like a pie. A company's stock is a pie, and each shareholder has a slice. When a stock split happens, the pie is cut into more slices. But here's the thing, the size of the pie doesn't change. It's still the same pie, just divided into smaller pieces. Let's take an example. Suppose you own a share of a company and that share is worth $100. The company announces a 2-for-1 stock split. What happens? Well, now you own 2 shares. But hold on, it doesn't mean you're suddenly richer. Those 2 shares you now own are each worth $50. Your total investment value is still $100. This is exactly what's happening with Chipotle's stock split. But instead of a 2-for-1 split, Chipotle is going for a whopping 50-for-1 split. That's right, every single share of Chipotle, currently trading at a hefty $2,900, will be split into 50 separate shares. But why do companies do this? It's all about accessibility. When the price of a single share becomes too high, it can be out of reach for many investors. By splitting the stock, the company makes its shares more affordable, potentially attracting more investors. So, in the case of Chipotle, if you own 1 share valued at $2,900, after the split, you'll own 50 shares, each valued at around $60. But remember, your total investment value remains the same. In the end, a stock split is like a magic trick. It changes the appearance of things, but not the underlying reality. It's a way for companies to make their shares more accessible, but it doesn't change the fundamental value of your investment. Now, with the stock split making Chipotle's shares more affordable, are you considering buying into the burrito giant? Chipotle, with its commitment to providing delicious and nutritious meals made from whole, unprocessed ingredients, has made a bold move. But what does this mean for you as an investor? Well, it's a double-edged sword. On one hand, this stock split could make Chipotle's shares more accessible to you. Instead of shelling out over $2,900 for a single share, you could soon own a piece of this burrito giant for around $60. On the other hand, we need to consider Chipotle's forward PE ratio of 45. Some would argue that this suggests the stock is overvalued, meaning you could be paying more for a share than it's actually worth. But remember, stock splits don't change the overall value of your holdings. They simply increase the number of outstanding shares, adjusting the price per share. It's worth noting that Chipotle's strong financial performance and record revenues have led to the decision for the split. So with the stock split on the horizon, are you ready to dip your toes in the Chipotle stock pool? Or are you planning to stay on the sidelines, observing how the market reacts to this record-breaking move? There's no right or wrong answer here. Just like the question they ask you in line, would you like guac with this? Investing is a personal decision influenced by your individual financial goals, risk tolerance, and market outlook. So, will you be grabbing a piece of the Chipotle pie, or will you sit this one out? We'd love to hear your thoughts in the comments. Well, there you have it, a deep dive into Chipotle's record-breaking stock split and what it could mean for potential investors. We've covered the announcement of this unprecedented 50-for-1 split, currently pending shareholder approval. We've also discussed what stock splits are and how they work, emphasizing that they don't increase your equity in the company, but rather make the stock more accessible by adjusting the price per share. We've also touched on Chipotle's current trading status, with its stock symbol CMG trading north of $2,900 on the New York Stock Exchange. Despite a forward PE ratio of 45, suggesting some think the stock may be overvalued, it's anticipated that this stock split could bring the share price down to a more reasonable $60 come summer. Now we're keen to hear your views. Do you hold any shares of the burrito giant? Or are you waiting for the post-split price drop? Your insights are always welcome in the comments section. If you found this video helpful, please give it a thumbs up and subscribe to our channel. Your support helps us create more content like this. And don't forget to share your thoughts in the comments. Thanks for watching.